Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking equities and E-minis back above the 50-day moving average, and we got to close above there, so things are looking up again in equities. Not that we haven't seen that time and time again. Most dips that we've seen in the equities, whether big or small, have been bought pretty aggressively, and this last move was no different. And if you go back to when this all started back in the middle of August, you have to come after right after the FOMC minutes. It looks like the market has sort of taken everything that it's known, all the risk, all the North Korean missile launches. We've had some weather crisis down in Texas, obviously with Hurricane Harvey causing a little distress, not only down there, but in the equity markets. We've had some things going on in Venezuela. The stock market's taking it all in stride. And while treasury yields are going down, suggesting there is a flight to quality in the market, things are calming and equity markets have resumed their move higher. And nowhere else do we see that clearer than in the volatility index and the VIX. The VIX index printed its first 10 handle since August 8th. Remember, that was the last time the S&P made a new all-time high. So we are back kind of in that mode where we start to see the markets get, I don't want to say complacent, but volatility goes down, equities go higher, everything else just kind of goes about its business, whether we're looking at extenuating markets in the treasuries or in the commodities. But for right now, it seems to be the lower volatility, higher index option spread is working. And so what do we have ahead now? We've got key numbers. We've got the PCE data, which is really the Fed's inflation gauge. And if you look at where it is, it's much lower than they would like. And we're expecting, I think, 1.4. The Fed wants to see that inflation numbers kind of creep higher, especially with all the stimulus that's been pumped into the market over the last 8 years. And I think that right now, those numbers are going to be kind of overlooked. We've got the employment report on Friday, and that'll kind of also be overlooked, I think, with the U.S. holiday weekend. More about how it's going to happen with Hurricane Harvey and recovery efforts down there. That will take center stage. Likewise, you can never keep the geopolitical stuff off the radar when you're talking about long weekends in the U.S. And I think that altogether, it could be kind of one of those risk-off weekends, and that could maybe lead to equities not extending to new highs, regardless of what the data says, and seeing treasuries getting the better bids heading into the weekend. So right now we are back into that positive trend. Equities never really got bearish, so we'll just say they're back into the old bull trend and heading higher, but may take a pause as we head into the weekend with a lot on our minds and a lot on our plates and a lot on the radar. But look for those extensions to continue next week, especially with a Fed that doesn't really know what it's going to do. Fed odds of another rate hike this year are still hovering in the mid 30% range. That's well below where the Fed would like it, and it really suggests that the market doesn't believe they're going to go by the end of the year. This has been Todd Colvin coming to you from the floor of the CME Group.